What is security? Security is basically when you invest your money, hard earned money, in shares, debentures, bonds, then it is called securities. Securities basically are financial instruments through which a public or private company raises capital. Capital can be raised in equity form or debt form. As you know, it's a equity share capital, preference share capital. Then there is a debt form. Company raises in the form of debt by issuing debenture bonds. Or there are hybrid instruments. These are called instruments. Equity share, raising money through by issuing equity shares. Then equity shares are financial instruments through which a company raises money. The money can be raised in the form of equity or debt or hybrid. Hybrid instrument means it's a combination of equity and debt. Basically, equity shareholder has a feeling that they are the owner of the company, but they do not have a fixed income. But debenture holders or debt holders are the one who don't have the right in voting, but they get a fixed interest rate, right? Fixed source of income they are getting from the debt holders get. But nowadays company issues hybrid financial instruments. Hybrid here means that the financial instruments they issue in the market has the characteristics of equity as well as debt. Basically, hybrid instruments has the characteristics of both equity and debt. So basically, for us, security means when you invest your money in shares, debenture, bonds, then we say you have invested your money in securities. We are not talking about gold, or we are not talking about properties, realty sector. We are not investing in properties, we are investing into shares. Now, as an investor, let us talk about shares, okay? When I'm talking about securities, you think I'm talking about shares. Now, when an investor wants to invest in a security, how do a person decides which company security he should buy? How do an investor takes a call? How do an investor decides which company shares to buy? How do he decide? Very simple answer. Anybody can say, ma'am, the company which gives high return, company which has less risk, that is the preferable investment option. The company which provides high return and less risk. Now you know a little bit risk. What is risk? Risk is basically less deviation. In deviation we'll talk about. Okay, let's not talk about risk. First of all, as a layman person, you know what an investor expects. An investor expects high return and less risk. So if you want to analyze a security like a layman, if you want to analyze a security, which security is good or which security is bad, you need to evaluate the return and the risk of a security, right? So that means we need to learn. First step of our lecture is going to be first concept that we are going to study is return. Understand the meaning of return. What is all included in return? How do we compute return on a security? This is going to be my next 30 minutes of lecture. What is return? What all are included in return? And how do we compute return on a security? Okay. Why are we learning this? Because we are doing security analysis. Why are we doing security analysis? Because as an investor, we are talking about money, finance. As an investor, I want to invest in a company and to invest in a company, I want to learn how the returns are computed, how the risks are computed when I'm thinking of investing in a security. So let us first understand return portion, then we will go to the risk portion. What is return? Okay, so first I will explain you the meaning and what all are included in the meaning of the return. And please understand, I'm talking very basics at the moment. Next 20 minutes also I'm going to talk very basics. Then slowly those basics will get complex. Okay, so you have to hold your patience to, everything is very simple, ma'am. Don't think that ways. First 20 minutes is going to be simple, then slowly I will take step by step to the complex part. Okay, let's start the return portion. Now, what is return? To understand the meaning of return, let us take an example. I have rupees 100. This is my capital. Okay. I have rupees 100 and this is my capital. I wish to invest this capital in some company's share. So I chose company A's share. Would like to invest rupees 100 in company A's share. Today I am investing in company A's share. After a period of time, the period of time can be 3 months or 6 months, 9 months. After a period of time, this rupees 100 share is now trading in stock market for rupees 130. Now, after a period of time, my 100 rupees capital has gone up to 130 rupees in the stock market. Company A's share are tradable in stock market. Tradable in stock market. So my 100 rupees investment has gone up to 130, and as per calculation, 130 minus rupees 100. So 30 rupees I am gaining. 30 rupees is my gain on by investing in the shares. Now I want you to tell me what type of gain I am gaining here. What kind of, I need a nomenclature for this word 30 rupees. What is this 30 rupees? Is it a dividend income? No, there is no dividend. I have introduced any dividend in the story. Then what kind of income is this on my securities? I am gaining something. I am gaining, this is some kind of return on my on securities. So what kind of return it is on securities? This is called as capital appreciation. This is termed as capital appreciation. My capital has appreciated from 100 to 130 over a period of time. It has appreciated. How much it is appreciated? By 30 rupees. So whenever I ask you that what is the return on securities, you will say, ma'am, first of all we have to check capital appreciation. There can be capital depreciation also. What is capital depreciation? If the share would have fallen down in its value, say by it has come down to 90 rupees, then my capital has eroded by 10 rupees. My capital has reduced by 10 rupees if the share is trading at 90 rupees in the stock market. So hence, first type of return which we should take into computation is capital appreciation. Okay. How did you compute capital appreciation? Let us give it some notations. Let me write like this. This is the share price. When I bought the share, I bought it for 100 rupees as on today, and over a period of time, this over a period of time can be 3 months, 6 months. I can keep my investment for 3 months, I can keep my investment for 6 months, I can keep my investment for 12 months also. So it's an over a period of time, my investment has gone up to 130. This is a share price. This is share price as on today, over a period of time, over a period of time. This is, instead of writing today, let's write this is the share price, 100 rupees share price at the beginning of my investment, right? I will give this as price, the notation I'm giving to the price is P. I'm giving it P0 and this as P1. Why? Because this is the price of the share at the beginning of the period, and this is price of the share over a period of time, P1. So how did I compute capital appreciation? 130 minus 100. So P1 minus P0 is my capital appreciation. This is return number 1. This is one type of return which I am getting from my security. So whenever I am going to invest in a security, I would look into the return in the form of capital appreciation. Fair enough. Now going to the second part. Is there any other return we get on our securities? Yes, we get in the form of dividend. If we are investing in shares, dividend. If we are investing in debt, then interest. And if we are investing in hybrid securities which have both the characteristics of equity and debt, then it is another form of return. So I'm investing in shares now. So the dividend is also another form of return. Dividend. Now you have to keep note something about dividend. What I want you to understand about dividend is, company keeps on declaring dividend. It is not necessary the company declares a dividend at the end of financial year. Company can declare the dividend in between the financial, in the middle of the financial year also, and it is called interim dividend. Interim dividend. Company can declare dividend any time. During the financial year, it can declare the dividend any time. That is called interim dividend. Okay. Now, what dividend is my income? If a dividend is declared over a period of time, when I have made the investment, I have made the investment on this date. After this date, if company declares any dividend, that I can claim. But if a dividend is declared before this date, that dividend is not my dividend. So whatever dividend is declared over a period of time, when I have purchased, after that if a dividend is declared, that is my dividend. But on the date of purchase or before that, if any dividend is declared, it is not my income. Ma'am, even when you have purchased the dividend, when you have purchased the share, on that day if dividend is declared, beta, there is a concept called ex dividend share price. Ex dividend share price and cum dividend share price. Just for 2 minutes, let's change the topic and come to this concept: ex dividend share price and cum dividend share price. This 100 rupees, suppose let's say this 100 rupees is ex dividend share price. What do you mean by ex dividend share price? That this 100 rupees is only the price of share I am giving to the earlier owner. The previous owner from whom I have purchased the share, if I have purchased the share at ex dividend share price, that means I am only paying him the price of the share. But if I am buying at cum dividend share price, cum dividend share price implies that I am paying him for the share as well as for the dividend which belongs to him, but since I have purchased the share, I am going to receive it. It is a possibility that the dividend has been declared before, but since now I have purchased the share, I might receive it because I am in the books of, my name is registered in the books of the company. Dividend might belong to this period, but since I have purchased the shares now, so the previous owner might say that, see, this dividend belongs to me, the previous owner, and now you are purchasing the share from me. So rupees 100 you give me, plus you give me the amount of dividend also, because that dividend belongs to the previous owner, but I will be receiving it because that dividend has not been received by previous owner, but that belongs to this period. So let's say dividend amount is 20 rupees. If I pay him 120, if I pay him 120, 100 for the share price and 20 for the dividend of this period. Okay, fine. That's I am paying him 120. I will receive this dividend for this period, but I am not going to gain on that dividend, because if I get 20 rupees dividend also of this period, I have paid the previous owner already 120. I have paid 20. I'm getting 20 from the company. So where am I getting the return? I am not getting any return. I hope I am making myself clear. Let me restate this all thing. If I purchase a share which is come dividend share price, that means I am paying the previous owner the share price as well as the dividend which belongs to him, because it is a dividend for this period, the period when I was not the owner. I have paid him 120. Now I am receiving this dividend which belongs to the previous period. This dividend I am receiving, but this is not the income because I have already made the payment for this to the previous owner. So this dividend which is declared on this date is also not my dividend, because I am making payment for that to him. But after this period, over this period, if I receive any dividend, that belongs to me. That is my return. Ma'am, so much focus on the word dividend. Yes, because when we are going to do the question, then there will be a confusion. Then, ma'am, which dividend is our income? So dividend which we get over the period of time, that is our dividend. Dividend on this date is not our dividend. Even if we are receiving it, it is not our dividend, because we have paid money for that to the previous owner. Understood? Hopefully you have understood. So what I am trying to say is the return is dividend over a period of time. That is our dividend. Now, please see what I am writing. D0, D1. What is D0? Dividend at the beginning. Even if I am receiving it, that is not my income, because I have already paid that amount to the previous owner. So this is DO. Dividend at the beginning is not my dividend. Dividend over a period of time. Dividend over a period of time is my income. So D1 is my income. Now let me write the full form of the notations. What is D0? This is dividend in the beginning of the period. What is D1? Dividend over a period of time. This is not my income, this is my income. What is P1 and PO? Let me write here. Ma'am, should we write all this? Yes, you have to write. Ma'am, how do we write all this? You keep on changing the sheets, papers. Very simple. You pause the screen and write everything whatever I'm writing on the paper. Okay. So best part is that you don't have to write simultaneously. When once I have finished this portion, you pause the screen and write everything what is it on the sheet. Okay. Some students say, ma'am, this is also clumsy. How do you know? How do we decide what to write, what not to write? See, I am trying here to explain something. So it will get little messy. But you can write everything. It's an example. Then there is a return on securities. I'm trying to explain that there is a capital appreciation, and dividend over a period of time is our return, not the dividend at the beginning. Okay. Now P0 and P1. What is the full form? PO, price at the beginning of the period. Have you noticed I'm focusing on every time on this word period? I am not saying this is price of a share as on today. No, price at the beginning of the period, and this is price at the end of, yeah, over a period of time. Okay. Now, my dear students, So we have understood there are two kinds of return, very simple. One, just wanted you to note two things. One is that the capital appreciation or depreciation is your return. How do you compute? P1 minus P0. P1 is your price of the share over a period of time and P0 is the price at the beginning. Then your another return is your dividend. Which dividend? The dividend on the date you have purchased the share? No. Even if you are receiving that dividend doesn't belong to you because you have already paid the price for that to the previous owner. Dividend which is over a period of time, that is your dividend. That is the actual earning you are getting over on your investment. Now we have learned the return portion. Is it complete? No, it is not complete. You can pause the screen and copy all this. I am changing the sheet. Now what is left in understanding the concept of return? Give me answer to this my query. I have a query. If there are two companies, company A and company B, I am getting, okay, I forgot to tell you something. Just in this example, interim dividend declared by company, let's say 20 rupees. So this was my income, 20 rupees was my income, 30 rupees was my capital appreciation. So in total, I was getting 50 rupees of return, right? I just said that 20 rupees, let's assume the interim dividend was 20 rupees, capital appreciation was 30. So my income on my securities is 50 rupees. Okay. Now my query. Answer the query, please. Suppose in company A, suppose from company A's shares, I am getting a return of rupees 50. This 50 includes capital appreciation and interim dividend. The same example. There is another company which is giving me 70 rupees return. Now please tell me, where should I invest my capital? In this company or in this company? Which company is better? We all know that company is better which gives you high return. So which company is better? So your answer is going to be, ma'am, company B is better. I assume this is going to be your answer. But just watch. Just see what I'm writing. Suppose I invested rupees 100 and I'm getting 50 rupees of return in company A. And in company B, if you invest 1000, then you get 70 rupees. Now tell me which company is better, company A or B? Your answer is going to be, ma'am, obviously company A is better. Because why? Because return on investment is higher in company A than in company B. Rupees 50, this is your return, divided by rupees 100. So you are getting 50% return. And here you are getting 70 divided by rupees 1000 into 100. You are getting only 7% return here. So another thing you should remember, I should say note in your mind, that whenever you are noticing return, don't be a layman. Don't say I need high return, high return. Say I need high return on my investment. Don't say high return. High return though company B is giving. High return on investment is given by company A. So second thing we must know, first we have understood what is return. Now we are understanding the return should be computed return as return on investment. Okay. So that means if I want to compute my return in this case, then just computing 30 and 20 is not sufficient. 50 rupees I am getting by investing how much in this money? How much in this company's share? 100 rupees. I invested 100 rupees na? On 100 rupees, my investment is 100 rupees on which I am getting 50 rupees of my return. So, if I try to make a formula of return on investment, if I'm trying to make a formula of return on investment, then what will be the formula? What was our calculation? 30 of capital appreciation, 20 rupees of dividend upon 100 rupees of our investment in the shares into 100. How did we compute 30 rupees? It was P1 minus P0, P1 minus P0 plus how we computed rupees 20. It was a dividend income over a period of time. Only D1 we have to take. We can't take D0. So D1 upon what is rupees 100? My investment in share at the beginning of the period. 100 rupees is my investment. 100 rupees was given as a notation P0. That is my investment. No, I have invested 100 rupees. It has gone to 130, but my investment was 100 rupees. I want to know how much I am getting return on my investment. So this is the formula of return on investment. Ma'am, now is this calculation finished? Is the return portion finished? Answer is no, it is still not finished. Last point which I want to tell you about the return is that, did you ask me, ma'am, is this return for how much period of time? Meaning, is this return for 3 months, 6 months, 7 months, 9 months, 12 months? And company B's return is for 3 months, 4 months, 5 months, 6 months. How much time duration we are keeping in mind? So whenever you are comparing two companies, you should also see the duration. Suppose this return we are getting in 6 months. And suppose from this company, this amount of return we are getting in 3 months. Now this is the return we are getting in 3 months, this is the return we are getting in 6 months. How can you compare both the companies when the duration of the return is different? So now the third point you should understand when you are computing return, that whenever you are going to compare the returns of the companies, it is a possibility that the return of one company can be of some other duration and some other duration of another company. In that case, you should compute annualized return. Annualized return computed for 12 months. In our example, we have taken, let's say, 6 months. Our return is for 6 months. So let us do one thing. If this is the return we are getting in 6 months in percentage, if this is the return we are getting in 6 months, then how much return we will get in 12 months? See my formula. 6 months we are getting return this much. So how much return will you get in 12 months? Now you do your computation. Very simple computation. See, 50 rupees return you get. Divide by 100 into 100. 50% dividend return you are getting, 50%. This return you are getting in 6 months. So 100 months में, sorry, 12 months में how much return will you get? 100%. 100% आ रहा है. Because why? Because in 6 months you are getting 50% return. So in 12 months you will get 100% return. So that is the percentage we are getting. Now if we do calculation for this is the calculation for company A. Let's do calculation for company B. The return, total return is 70 rupees. Okay. Investment you have done 1000 rupees into 100. This is return you are getting in 3 months duration. If 3 months duration you are getting this much return, in 12 months how much will you get? Now compute this return also. 70 divided by 1000 into 100. This is the return, 7% return you are getting into 12 divided by 3. So 28% return you will get. This is your beta annualized return. And this is also annualized return. Now you can compare. Obviously, we are getting better return in company A than company B, so we are going to choose company A. But now it is comparable. Earlier it was not comparable because duration was different. So when I started the this chapter, portfolio, the security analysis, just a minute. Yes, when I started this chapter, I told you that whenever an investor thinks of investing in securities, he looks up for two things. He needs high return and secondly, he needs less risk. So whenever you are computing returns, you have to keep in three things in mind. Return includes capital appreciation and second return is your dividend return. Okay. Dividend over a period of time. Return over a period of time. then return should never be taken in absolute form. Never take return in absolute form. Always check return on investment. This is the right way of computing return. So now next time onwards we will say an investor wants high return on his investment. Third thing, never compute return on investment only, always compute annualized return on investment. Annualized return on investment meaning compute the return for 12 months. Then you can compare all the companies. So what is the formula for annualized return? This is the formula which you should memorize. When you will get summary charts of the formulas, you will get this formula. Annualized return on investment P1 minus PO. Repeat with me if you are a sincere student. P1 minus PO plus D1 upon P0 into 12 upon M. Now, please understand, never learn the formula by notation. Always learn the formula by its meaning. What I want to say is, never say P1 minus P0. No. Say annualized return on investment. What is the formula? Capital appreciation, which is, name the word capital appreciation. How do we compute capital appreciation? The price at the end over a period of time minus price at the beginning of the period plus dividend over a period of time upon price at the beginning of the period into 100 into 12 upon months. That's how you should say, keep on revising the formula in this fashion. Okay, now this is the return portion which is complete. Now we are going to do a question from our material, study material. I hope you all have your study material with you. Even if you don't have, I will show you the question on the screen. So even if you don't have, that's not a problem. We'll start with question number first, conceptual question of portfolio. Conceptual questions, page number 3 to 8. Let's start with the question portion. Yes, is it visible? Okay. First question we are going to do, it is all about return. Understand, we are studying security analysis. So security, we are analyzing security from the point of view of return. So problem number 1, see the problem number 1. Okay, let's start question number 1. The dividend per share and market price per share of AB Corporation during the last few years are listed below. They have given you the dividend income and they have given you the market price, which is market price per share during the last few years. It is a historical data. Historical data implies that it is not the data of the future, it is data of the past. So it is the data of the past. They are giving you for the last few years dividend income as well as they are providing you the market price of the share. Compute the annual return. You have to compute annual return. For every year you have to compute the return. And we know whether they stated or not, you have to compute annualized return on investment. You have to compute in percentage whether they stated or not. Annual return and the expected return. I have not yet taught you expected return, but expected word has been introduced in the introduction portion. Expected, you remember, expected inflow outflow. So expected return we will compute, but first let us compute annual return, and we know what is annual return, but you have to understand whether it states or not, you have to compute annualized return on investment. Okay, they have given you year 0, year 1, 2, 3, 4, 5. What is year 0? Ma'am, it is as on today. No, it is not as on today. It is at the beginning. At the year 1, year 2, year 3, year 4, year 5. It is at the beginning of the period. Beginning of the period. You cannot say as on today. This is 5 years data. As on today, it's something else. These are last 5 years data. Okay. So this is at the beginning, at the start. At the start of the period, the market price was 30. At the end of the year one, it came down to 20. Then at the year two, let me ask you one thing. Suppose in year one, year two, these figures are at the beginning of the year or at the end of the year? It is at the end of the year. Beginning of the period 30 rupees market price. At the end of year one, market price is 20. At the end of year two, it is 28. At the end of year three, it is 42. And similarly. So whenever there is a time period given to you, 1 year, 2 year, it is at the end of that period that figure belongs. Okay. Dividend is given at the beginning, at the end, at the end, at the end. Now we need to compute what? Return. How do we compute return? Very simple. Whenever you have to give the answer in paper. Yes, now very important portion. Exam pattern has changed. It can change again also. We don't know. So exam pattern has changed. You need to work on your typing speed. You need to keep do the typing portion also. You need to write on paper as well. They give you the rough sheets also. And there's lots of things going on in CMA Institute. So how do we present this answer? Either the question can come in objective. How can the question come in an objective? The same question can come in an objective form. They need not give you 5 years figure. They can give you only 2 years figure. Figure at the beginning, figure at the end of the period. And they can ask you compute the annual return. You can compute easily. That can be an objective question also. And or it can be a subjective question also. In that case, you have to do the proper presentation. How do we do the proper presentation? Let's see. This is your answer number 1. Even though answers are given in your this book, but still I would appreciate if you write down the answers. Ma'am, what are you doing? I'm trying to put the answer as much in tabular form. So whatever working I'm going to do, I will try my level best to do it in a tabular form. So I'm trying to prepare columns here. These columns will represent my return. There are two types of return. One is capital appreciation and one is your dividend income. So that's what I'm trying to write here. This is my year. This is my dividend income. Then there will be a capital appreciation income. This is column number 1, column number 2, column number 3. Then this is total return. Column number 2 plus column number 3. Total return is nothing. Total return is not important. We need to compute return on investment. So I need P0, that is base market price. Then I will compute return annualized. Yes, this is my annualized return on investment. Year 1, 2, 3, 4, 5. Ma'am, why have you not written 0? Because 0 is the time when I have purchased this share. When I have purchased this share, how can I get a return on the same day? Over a period of time, I will get return. So by the end of year 1, how much is my return? By the year end 2, how much is my return? And year 3, by the year end 3, how much is my return? Okay. So this is my answer in tabular form. You can prepare these columns through a scale also. So let's start with the dividend income. Let me see how well prepared you are through my teaching. What have I taught you? You should always take dividend. Which one? Dividend at the beginning or dividend over a period of time? Ma'am, dividend over a period of time, because dividend at the beginning, even if we receive that dividend, still it is not our dividend. So dividend over a period of time. Very good. Dividend over a period of time is my return. Now let me go back to my question. Let me go to the question. This is my question. Okay, now font size is small. Give me a moment. Okay. Okay. Now for the first year, at the beginning of the period, I am getting 1.75 dividend, but this is not my dividend. Over a period of time, this is my first dividend income. At the beginning of the period when I get the dividend, even if I receive that dividend, this is not my dividend. This belongs to the previous owner dividend. Or this is not my real income. This is my real income. So first year, this is my dividend which I am getting at the end of the year 1, because this is what I get on my investment over a period of time. So first year dividend is 1.75. 1.75. Even though 1.75 is same for both the beginning and over a period of time, but still this is my relevant income. For the year 2, this is my dividend, because over a period of time I am getting this dividend, and third year this, the fourth year this, and fifth year this is my dividend income. So for second year over a period of time I am getting 2.50 dividend income. Then for over a period of time I am getting, for the third year I am getting 3.20. Then similar fashion mein I'll go 3.8 and 4.5. What I wanted you to understand is that this dividend income is not relevant. Only D1 income is relevant. These are D1 incomes over a period of time. Over a period of every year, over a period of time. Every year is taken independently. Understand this also. Every year is independent, meaning when year 2 we are thinking, then year 1 becomes the base year, and year 2 is your over a period of time. Okay. So take it like this. If you're talking about year 2, this is your base year. Get this. By over a period of time, you get this dividend. Fine? Cool. Now, second portion is your capital appreciation. What is the formula of capital appreciation? P1 minus P0, right? What is P1? Price over a period of time minus price at the beginning. So for the first year, when you purchase the share, it was 30 rupees at the beginning, and over a period of time, the share has gone down to 20 rupees. So for the first year, this is P1 and this is P0. 20 minus 30 minus 10. 10 rupees, your capital has appreciated or depreciated? Depreciated. For first year, your capital has depreciated. 20 minus 30, that is minus 10. समझ आ रहा है? Understanding? Sometimes you might see I'm using Hindi words because earlier batches I used to take in Hindi mode, so there might be a possibility that I might use some Hindi words. Okay. Okay. Coming back to our concept. Now let us. We are talking about year 2. For year 2, my base price will be this now. This is going to be my base price, and this is going to be my price over a period of time. At the beginning of this year, at the beginning of year 1 will be the year 1, sorry, at the beginning of year 2 would be the end of year 1. At the end of year 1, the prices are 20. So at the end of year 1, if price is 20, that would be the price at the beginning of year 2. Now the share price, which is 20 at the beginning of year 2, has gone up to 28 rupees at the end of year 2. So I am gaining 8 rupees. My capital has appreciated from 20 rupees. It has gone to 28 rupees. So previous year's share price now become the base price. Becomes the price at the beginning of the period. Okay. So 28 minus 20. 28 minus 20, which is 8. Then similar way, we are going to like this. We are going the same way. Now this becomes P0 and this becomes P1. At the beginning of year 3, is the end of year 2. The share price was 28. Then at the end of year 3, the share price has gone to 42. So 42 minus 28. How much is this? 14. We are gaining by 14 rupees. It is 42 minus 28. 14 rupees you are gaining. Okay. In a similar way, now this becomes P0 and this is P1. 42 has gone to 50 rupees. So 50 minus 42, that is 8 rupees you are gaining on your shares investment, and 50 rupees share now it becomes the price at the beginning of the period, and this is price at the end of the period. 50 rupees share goes to 80 rupees. Now that is 30 rupees gain. 80 minus 50, that is 30 rupees your capital appreciation. Now okay, now we have computed both kind of return, dividend income also and capital appreciation also. Now let's add them up and compute the total return. So column 2 plus column 3, 1.75 minus 10. So in the first year you have a negative return. Obviously you will have a negative return because your capital has eroded. Second year 2.5 plus 8, 10.5, 14 plus 3.2, 17.2, 8 plus 3.8, 11.8, 30 plus 4.5, 34.5. This is your total return. Now I have already told you, never take the absolute return, always take the return on investment, that too annualized one. So for return on investment, what is the formula for annualized return? What is the formula for annualized return on investment? It's P1 minus P0, capital appreciation, plus dividend over a period of time, divided by share price at the beginning of the period into 100. So share price at the beginning of the period, you need this. You have already computed the numerator, you need denominator. So let's go to denominator portion. You need share price at the beginning of the period, right? At the beginning of first year, what is the share price? At the beginning of first year, what is the share price? 30 rupees. At the beginning of the first year. At the beginning of second year, beginning of the second year is the end of first year. What is the share price? 20. For the third year, what is the share price at the beginning? Third year share price at the beginning is the year second's end share price, 28. What is the share price for beginning share price of year 4? The share price at the end of year 3 is the beginning of the share price of the year 4, 42. And then for year 5, beginning share price is the year 4 end share price, 50 rupees. So this is your share price at the beginning, base price, base market price. Now simple. Okay guys, let's compute annualized return. Very simple formula. How do we compute annualized return? We have already the total income, numerator portion minus 8.25 divided by your investment in the share price into 100. And this is, since annualized return, this is return for whole year. So it is not a monthly return, so it is already annualized return. Otherwise, in this formula, you need to have mentioned 12 divided by M also. But since it's already an annual return only, okay, so let's compute this. This is coming out to be minus 27.5. For second year, total return is 10.5 divided by the investment into 100, and this is I'm doing some cheating. I'm copying the answer because that's a mathematical computation. Next portion, total income 17.2 divided by your investment 28 into 100. This is coming out to be 61.4%. Then total return 11.8 divided by your investment into 100. This is coming out to be 28.1%. and last 34.5 divided by 50 into 100, this is your 69.0%. If you add all this is total return for 5 years is 183.5%. This is total. Okay, so first part of the question is complete. What is your annualized return? We have computed this company in the year 1 has given you a negative return. Then if you invest in this company, first year is your loss, second year, third year, fourth year, you are gaining. Question asked you another thing also. Something else also he has asked you. What he has asked you? Whenever I do the zooming, it becomes little of blurred, so it takes fraction of seconds to get normal. The screen takes time to get normal. Okay, so the second portion the question is asking is compute the annual return that we have computed and the expected return. Expected return. What is expected return? Now this is a very important question. What is an expected return? From this company in past 5 years you are getting this return. Where is the return? Okay, for last 5 years you are getting these returns, minus 27.5, 27.5, 52.5. In third year you're getting this. These are actual returns which company is giving you. These are the actual returns which company gave you in the past few years. Now how much return you expect from this company in future? Now obviously what return company will give in future depends on its past performance also, na? Suppose if you give your mock test, if I take your mock test of SFM while studying, I take your mock tests and you are scoring 40 marks, 50 marks, 60 marks. So obviously in CMA final exam also, you will score the same marks or around, you won't score 90 marks. Na? If you are scoring 40, 50, 60 marks in my exams, when I am taking your paper, when I am taking your test, you are giving me, you are scoring only 40, 50, 60 marks. How can you score 90 marks in the CMA exams? Normal situation, if you predict a normal situation, then obviously your marks will come something around those figures which you are getting in my exams also, around 40, 50, 60. So similarly, whatever you expect in future, it depends upon your past performance. Company will not give you surprising results in future unless a drastic change happens. Normal situation, you expect normal results. Results normal, what I mean by normal results, the company has performed, how the company has performed in past, it is expected from company to perform in the same fashion in future also. So company has performed in this fashion, so it is expected from company to perform in the same fashion in future also. Now that means company can give in future a negative return of 27.5%, or it can give you 52.5%, or in future you can expect from company 61.4. Oh my God, there are so many observations. There are so many observations. Please see this word. This word is very, very, very important. There are so many observations. There are approximately 5 observations from historical data. Now, what should I expect from company? So let's do one thing. Whenever you have number of observations and you need one final figure out of these observations, then let's do one thing. Let's take an average of these figures. Whatever company has performed in past, on an average, it will perform in future also. So let us take an average of these figures. There are 2 kinds of average. One is simple average and one is weighted average. My next portion of explanation will be in this area. We are still studying in return only, beta. First we taught you annualized return. Now we are teaching you expected return. Now we are going in future. What performance do you expect out of this company? So we are trying to teach you how to compute expected return. Expected return, how do we compute? We take the average of past returns. Now, average can be computed simple average or weighted average. In this case, we are computing simple average. Then we will discuss about weighted average. How is simple average computed? Add the number of observations and divide by number of observations. When you add these observations, it comes out to be 183.5. So, expected return is 183.5% divided by number of observations. How many observations are there? 5. So when you do this, 183.5 divided by 5, you get 36.7% return. This is your expected return. This is your R bar. Ma'am, what is R bar now? This is your mean. In school you must have learned average, mean, R bar, average. R means return. So you have computed simple average. So two things now you should retain in your mind is, whenever you are computing expected return, you have to look into the historical data. In historical data, if number of observations are many, then take an average of the same. Average can be computed in two ways: simple average, weighted average. Even average can be computed in many ways: harmonic average, and there are many kinds of averages, but we are talking only of simple average and weighted average. So we computed simple average, we added the figures. Instead of adding word, use summation. We have summated these figures, summation. Ma'am, what is now the summation is? I'll tell you, don't worry. This is a notation we use for summation. We have summation means we have added these figures. How much is the summation? 183.5%. How many observations you have added from first to fifth observation? So I is equal to 1 to 5. I means number of observations. How many observations you are adding up? From first observation to fifth observation? Yes. So that means I is equal to 1 to 5. If you are adding only 3 observations from third to fifth, then I is equal to 3 to 5. That means third, fourth, fifth. 3 observations, you are adding third, fourth, fifth observation. But we are adding total 5 observations. So I is equal to 1 from 5. This is summation sign. You compute R bar, mean, average, expected return. So we are understanding return portion and we have understood a lot. Now you can write it down, and next, now my portion of lecture will go on to weighted average. I hope you have understood simple average, and now focus should not be on simple or weighted. Focus should be on this word, because slowly we are going to move to the famous word risk. For risk, we need to know the word expected return, and anything, whatever you expect, depends on the historical performance. So write it down, pause the screen, and then we will move on to the concept of weighted average.